For years, big tech stocks looked almost unstoppable. Apple, Microsoft, Nvidia, Amazon, Google, Meta. These companies became the center of the stock market, driving huge gains across retirement accounts, ETFs, index funds, and investment portfolios around the world. And for a while, the strategy seemed simple: own the biggest tech companies and let them carry the market. But now, more investors are starting to ask an uncomfortable question: what happens when the market becomes too dependent on a small group of tech giants? Because the risks of overdependence on big tech stocks are becoming harder to ignore. Over the last few years, a handful of technology companies have been responsible for a massive share of overall market growth in the United States. That sounds great during strong markets, but it also creates concentration risk. When too much market momentum depends on too few companies, the entire system becomes more fragile. And this is exactly what concerns some analysts today. The issue isn't necessarily that big tech companies are weak. Most of them remain extremely profitable, globally dominant, and financially powerful. The issue is expectations, because once companies become this large, investors expect near-perfect performance constantly. Every earnings report must impress. Every AI announcement must excite the market. Every quarter must show growth. And eventually, maintaining those expectations becomes harder. We're already seeing this pressure build. Major tech companies are spending billions on artificial intelligence, cloud infrastructure, semiconductors, and data centers. Investors currently support this spending because AI is viewed as the next massive technological revolution, but AI also introduces uncertainty. Nobody fully knows which companies will dominate long-term. Nobody knows how profitable some AI tools will become. And nobody knows whether current levels of spending can continue forever. That creates risk for markets heavily dependent on tech momentum, because if investor confidence weakens even slightly, highly concentrated markets can react aggressively, and history has shown this before. During the dot-com era, investors became obsessed with internet companies. Technology stocks dominated headlines, valuations surged, and money flowed heavily into a single sector. Some companies survived and became giants, others disappeared completely. The lesson wasn't that technology failed. Technology eventually transformed the world exactly as many predicted. The lesson was that markets become dangerous when excitement concentrates too heavily in one area, and some analysts believe modern markets are starting to show similar behavior again. Not necessarily another crash, but another period where investors may be relying too heavily on a small group of companies to drive overall growth. This matters because big tech now influences far more than just stock prices. These companies control cloud computing, AI infrastructure, smartphones, online advertising, software ecosystems, e-commerce, and digital communication. Entire industries depend on them. Which means if growth slows across several major tech companies at the same time, the effects could spread much wider than people expect. Another growing concern is valuation pressure. When investors become extremely optimistic about a company's future, stock prices often rise much faster than the actual business itself. At first, markets justify this by focusing on future opportunities, but eventually expectations become incredibly difficult to satisfy. A company can still report strong profits, rising revenue, and growing demand, and the stock may still fall if investors expected even more. That's the strange reality of modern tech investing. Success alone is no longer enough. Companies must constantly exceed expectations, and the bigger they become, the harder that challenge gets. There's also a hidden risk inside passive investing. Millions of people now invest through ETFs and index funds that automatically place large amounts of money into the biggest companies. That means many investors believe they are diversified while actually holding heavy exposure to the same group of tech stocks underneath. If a few major technology stocks decline sharply, large portions of the market could fall together. And because money continues flowing automatically into the biggest companies, concentration keeps increasing. This creates a cycle where successful companies become even larger simply because they're already dominant. But history shows no company stays on top forever. Technology changes quickly. Consumer behavior changes quickly. and competitive advantages can disappear faster than expected. BlackBerry once dominated smartphones. Yahoo once dominated internet search. Intel once looked untouchable in semiconductors. Today, the market leaders are different. That's why overdependence on current tech giants creates long-term uncertainty. Because investors sometimes assume today's winners will remain dominant indefinitely, but innovation rarely works that way, and ironically, AI itself could eventually disrupt some of today's leaders. That pressure is already visible. Apple is racing to integrate AI into its devices. Google is trying to protect its search business during the rise of AI assistants. Microsoft is aggressively pushing AI into workplace software. Meta is investing heavily in AI infrastructure and smart devices. Every major tech company is fighting to avoid falling behind, and these battles are becoming extremely expensive. AI infrastructure requires enormous spending on chips, electricity, networking systems, data centers, and research talent. Right now, markets are rewarding that spending because investors believe AI growth will justify the costs, but eventually investors will demand results. And if AI profitability takes longer than expected, market sentiment could shift quickly. Another major risk is regulation. As tech companies become larger and more powerful, governments are paying closer attention. Antitrust investigations, AI regulations, app store policies, and data privacy laws are becoming increasingly common, and regulation creates uncertainty for future growth. Large tech companies became powerful partly because of scale, but regulators increasingly worry that too much scale can limit competition and reduce consumer choice. That doesn't mean big tech is collapsing. Most major technology companies remain incredibly strong businesses with huge ecosystems and billions of users worldwide. But strong companies can still create risky markets if investors become too dependent on them. And that may be the bigger issue right now. The stock market is increasingly tied to the performance of a small group of tech giants. Investor confidence is increasingly tied to them. AI optimism is increasingly tied to them. That level of dependence creates vulnerability, because markets become less resilient when leadership narrows too much, and that's why some investors are beginning to shift attention toward other sectors like manufacturing, healthcare, industrials, energy infrastructure, and smaller software companies. Not because technology is disappearing, but because relying too heavily on one part of the market eventually creates imbalance. The companies dominating today's market could continue growing for years, but history shows that no sector stays unstoppable forever, and that's the real business risk of overdependence on big tech stocks. Not that technology will stop mattering, but that markets may have become too dependent on believing these companies can never slow down.